Welcome back to Intrendias. I'm looking at Wingstop stock today, potentially overvalued stock. So let's review some of the line items in the financial statements. Here I have data from quarter one 2022 to quarter four 2023. That was the span of data that I was able to get from tikrticker.com. First up, we have the net income rising 116% from this time frame. So really stellar growth here for the net income. However, just to keep in mind, much of this growth happened in 2022 compared to 2023. If we look at quarter four 2022 to quarter four 2023, the net income increased 6.8%. Only 6.8% compared to the entire duration of this data set going up 116%. So fast forward into 2024, we had annualized GDP come out at 1.6%, which was lower than expected. The expected 2.4%. So that 1.6% is telling us that consumer behavior is going to deplenish. We're going to see lower spending from these consumers. And if that trend continues, that's going to be a real headwind for these fast food chains. Moving on to the balance sheet, we're seeing cash and equivalents decline 68% from 287 million to 90 million. So obviously, it's not a bad thing to use cash. However, we want to keep a healthy current and quick asset to ratio. Looking at total current liabilities, down 58%. So it's good to see that your liabilities, your debts are being paid off. However, we are noticing that the cash is decreasing a bit faster compared to the current liability. Total liability is down 10%. Moving on to cash flow. Cash flow is king. Here we see 80% increase in the cash flow from 14 million to 25 million. 80%, which is great, half of which from 2022 quarter four to 2023 quarter four, up 40%. So the cash flow is doing great, and it is positive and growing, which is something that I love to see. We get into the return on asset, capital, and equity ratios. The ROE is negative, which is not the best thing to see. You'd usually like to see around 20% ROE. This provides insight into the financial health and performance of Wingstop. It reflects the company's ability to generate profits without relying heavily on debt financing. So considering the ROE is negative and we're in a higher interest rate environment where borrowing is a lot more expensive compared to what it was 2020, 2021, 2022, we're seeing a negative ROE, meaning Wingstop might be relying heavily on debt financing to generate profits. And we're seeing that the cash and equivalents is depleting quite rapidly, down 68%. So putting these two things together, it might be that down the road, Wingstop would have to continue borrowing on higher interest rate debt, which could damper the stock. If they could keep their free cash flow flowing positively and keep it going, then, potentially they could avoid a lot of that debt. But still, they might be relying heavily on that debt to keep profit. The market cap has increased 132%, which is pretty large returns there. We're going to move on to basic EPS, which is at 0.64 most recently. Taking that into consideration, we have the PE ratio, and we are seeing $400 on the PE ratio. Investors are willing to pay $400 for every $1 of earnings generated. We'll compare this ratio, among others, to comparable businesses in the market. We're seeing PS at 59, and the average PS is at 45. So towards the right, you could see that both PE and PS currently are above Wingstop's average, potentially meaning that there's a premium on the stock compared to relative to itself. And then also next 12 months forward looking price to free cash flow is suggesting that Wingstop is once again overvalued with price to free cash flow above the Wingstop average. Also, we have the PE ratio by industry. So from full ratio, so for restaurants, it's at 18, and then the PE for Wingstop at 400, so clearly a big difference there. And then from NYU, we have the price to sales ratio of 3.4, and then average for Wingstop is at 45. PS for Wingstop end of year is at 59. So definitely big distinctions for Wingstop. So we've seen a couple financial statements here. Why don't we go over to the valuations and check out what Wingstop looks like relative to its peers and competitors. Here we have Wingstop on column B. We have the return on asset, capital, equity ratios, along with revenue, EPS, free cash flow, price to earnings, price to share, and price to free cash flow, along with EV to EBITDA at the very bottom. Here we see that Wingstop has positive return on asset and capital, but again, it's negative for the equity. And we're seeing that Yum Brands is actually outperforming Wingstop in the capital assets or return on assets and return on capital ratios. However, Yum Brands experiences a lower EV to EBITDA at 19 compared to Wingstop's 88. And the Yum Brands price to free cash flow, price to share, and price to earnings are all at a discount compared to Wingstop. Even when the free cash flow that Yum Brands produces at $342 million compared to Wingstop's $25 million suggests that Wingstop is pretty overvalued. And either that or Yum Brands is at a discount. So it could be a one-way or two-way street there. We're looking at Wendy's as well. Pretty low return on asset and capital. However, their ROE is very strong, 57%. QSR as well. QSR owns Burger King, Popeyes, and Firehouse Subs. They're at 70.4%. These numbers are from tikrticker.com. Their ROA and C could use some work similar to Wendy's. However, their ROE is very strong compared to Wingstop. QSR's free cash flow is at $356 million, according to the quarter 4 result. And McDonald's free cash flow sitting at $1 billion, 1.7 right there, blowing everybody out of the water. However, McDonald's EV to EBITDA is 17 compared to Wingstop's 88. And then same with the PEPS and PFCF. They're all at a discount relative to Wingstop. I feel like these ratios here are suggesting that Wingstop is heavily overvalued with a price to earnings of 459, 298. And you look at these other reputable brands who are producing more free cash flow, $342 million in free cash flow, $356 million in free cash flow, $1.7 billion in free cash flow. Wingstop is only producing 25 million in free cash flow. However, their price to free cash flow is double Yum Brands and McDonald's, which is kind of hard for me to wrap my head around. I get it. Wingstop has a lot of growth potential. They're increasing their chains. They're increasing their locations. They had a great run even during COVID. They were able to be agile during that environment. However, the financials seem to be getting uh, ahead of themselves. The valuation seems to be getting ahead of themselves and not following the financials well. So I'm curious what you guys think about Wingstop stock. They have earnings coming out May 1st, and I feel like the earnings has to be incredible. I think the investors have gotten very excited for good reason. The free cash flow is up 80%. Um, and they're opening chains, and there's a lot of enthusiasm and loyal customers to Wingstop. Simultaneously, I think the investors got a bit ahead of themselves. Similar, like let's take a look at Tesla. Tesla reported earnings last week. Tesla was getting hammered. It was how down was Tesla? Now I'm curious. Um, so say in April, right? In April, 2 weeks, it's down 20%. It was down 20% before earnings. So going into earnings, the market priced in the worst of the worst. Yes, Tesla had a bad quarter, but then Tesla revealed the robo taxi, the more affordable car lineup, and they're going to accelerate the production of more affordable models. And then the stock jumps, say like 20%. It goes back up 20%. So I feel like the market is pricing in the best of the best for Wingstop. The market is pricing in an amazing quarter for Wingstop. And even if Wingstop has good earnings, if it's not good enough, even if it's good, if it's not good enough, I could see the stock going down. I think the market values this stock very highly and perhaps a bit too much. So I'm excited to see what happens with Wingstop next week. Earnings May 1st. Excited to see what happens for the stock. Um, I'm still debating if I should buy, say, puts into this or just sit on the sideline. So I'm curious what you guys think. Um, just to update you on my Comcast, I had a video uh, the evening before earnings. Unfortunately, Comcast they had great earnings. They had a great report. They had solid numbers from the theme parks. Peacock losses were have tightened, and even with all the good news, the stock is down. Say, I think it was 5%. So unfortunately, the Comcast play has not worked out for me. I still have the call option since my expiration date is out to 2025. So I'm hoping for a bit of a bounce back prior to selling that position. But since I'm filming this video, I wanted to update you guys with the Comcast. I'm still holding uh, my call position on that one. But let me know what you guys think about Wingstop and what we are seeing here with the financials. I just think with the EBITDA, price to earnings, price to free cash flow, I think these metrics are suggesting that Wingstop is overvalued. I think the market is pricing in the best of the best. And even if the earnings are good, if it's not great enough for the market, I could see it going down. But of course, and is not financial advice, and this is just entertainment for you guys. I hope you enjoyed uh, my little talk on Wingstop stock. I'd love to hear your opinion down in the comments below. What do you guys think about it? Do you think it's overvalued? Do you think it's still a good play? I'd love to hear your opinions on that. Check out intrendias.com as well for free buy and sell signals on your favorite stocks, cryptos, and Forex. And I will see you guys in the next one.